Greetings, everybody. This is Jeff Scott. This is my weekend review for December 30th, 2018. I guess that's the last time we'll be saying 18 on one of these. Hope you're all having a wonderful holiday season and you made some money at the end of last week. It's been beautiful down here in South Florida. We're on the boat yesterday with a bunch of friends and new friends. We had 17 people on a boat and it wasn't even crowded. I titled today, Santa Claus Brings Week to a Close. Now, what will the new year bring? My email address is hgsidoc@gmail.com. Please hit like and subscribe on YouTube. That way I know people actually are watching this and want me to continue. And subscribing means if I forget to send out an email notifying that I put it up or you don't get that email, you can still know that there's something to be seen. Disclaimer, it's for education purposes only. I'm a doctor, not a broker. I'm independent. I use a lot of different software. I pay for all that software. Trading involves risk, and you alone are solely responsible for any investment decisions you make. I follow a number of people, or at least I've had a number of people influence me. I do this report independent of anybody before I watch anybody else's video, in fact. I started with CanSlim, which was approved by Morales and Catcher, taken to the computer at highgrowthstock.com. by Ian Woodward as sort of the spiritual and intellectual brains behind it. Ron Brown went from a attendee at meetings like I was to Ian's partner, and they started Woodward and Brown Investing. We lost Ian a short while ago. Ron is still with us and has a wonderful educational approach, which is different than mine, more about volume spread analysis, but is an active supporter of the software program and educator. My buddy George Lee from Western Canada, who I share the podium with multiple times. Van Tharp, king of position size and money management, critical especially in times like we are today. Cigar from Superior Profits, got some great tools. And then my friend, mentor, buddy, John Person, author, developer of some great software tools into algo trading. Really has taught me not just how to find the stocks that are good, that I learned on the left, but how to actually trade them. I own a lot of programs. I need TradeStation or Thinkorswim. They're always open on my desktop because I've got a number of indicators that help me to be better at what I do. And then from an analytic perspective, I use HGSI, EdgeRater, and a number of the SuperiorProfit.co because it's a Singapore company, tools, the Edge Vital, etc. I do follow seasonality, but in times of market craziness that we're in, I think seasonality is clearly trumped by technicals, and right now technicals make it difficult to look out 3 weeks from here, and then a number of different websites. HighGrowthStock.com, that's the website that supports the program that I use most often, HGSI. Key things here are a free 30-day trial and under investing strategies. And you'll see a lot of videos by me, Ron Brown, and occasional others like Gil Morales, who has been known from time to time to use HGSI as well. Stock patterns are cyclical. We have been clearly in a Weinstein stage 4 sell-off. When we were up here at the top, every time it looked like we were going to roll over, we went to another leg higher. Well, now we're approaching perhaps a bottom. And is this a real bottom, or are we just going to get teased and take another leg lower, which we'll talk about as we go forward? You have to change your approach. This is not a time yet, in my opinion, to be loading up. It's a time to be cautious and playing it to the downside, or at minimum, playing it neutral and raising cash. Now, Friday didn't finish strong. The NASDAQ was up a little bit and the Dow was down double figures. Not a big move, and you can see that it's sort of a mixed picture here on the sector review. What was weak? Materials were clearly weak. Industrials were relatively weak as well. On the other hand, staples and discretionary have a lot of green. Utilities have green. Healthcare has green. Real estate has green. The foreign ETFs look good, which meant the dollar was probably weak, which it was. But probably mixed to better than mixed looking at it this way. Now, the major markets tell the story. On the upper left-hand corner, we have the E-mini futures, the NASDAQ futures, and then the Dow futures. The lower left-hand corner, I got the Russell ETF. I can probably change it to the RTY. There's enough data. The VIX futures and the dollar. So what do you see? Everybody is in a downtrend across the top and in the lower left-hand corner. And then we start to see some green coming in, at least for Wednesday and Thursday, and forming dojis across the board on Friday. Dojis are indecision days, and that's probably apropos for a holiday weekend and low volume type of a day. So I think we're clearly at decision points. The VIX has come off its highs. We'll look at it in HGSI, and the dollar has come down some as well. On the weekly charts, I love magnets, and I love seeing here that the E-mini futures came down and tagged its 200 weekly moving average, which with some basic math would be about the 1,000-day daily moving average. That would be a natural stopping point. Now, will the markets bounce here because the E-minis bounced? The NASDAQ and the Dow are behind. Are they coming down to bounce? Or is this just a bull trap here on the E-minis and we're going to break down like we did on the Russells? I think time's going to tell. Again, VIX is still markedly elevated. Here's the weekly compared to the spike from earlier in the year. We haven't seen that big washout day, perhaps, although we had a pretty big down day on Monday of this past week. Rates continue to fall. In white, yellow is the S&P 500. It's interesting with the Fed still talking tough. Rates are falling, and you'll see how bonds have reacted to the upside. If I look at the yield curve, it continues to, in blue, I know it's not easy to see here, it's just the color that came on the chart, is tracking towards the zero line here. When it gets to this line and below it, it's an inversion, and that's what they talk about on CNBC. Now, as I pointed out many times, blue here is the yield curve. Pink is the S&P 500. Now, notice as the yield curve is falling, even till it gets negative and stays negative, the S&P still goes up. It's when the yield curve turns up and starts to rise that the markets fall over. So this is probably when the Fed starts to tighten and rates go up. And because of a falling yield curve, they have to cut rates, and therefore the market goes higher. So I'm not sure that a flattening or falling yield curve by itself means the end of the market days. You can't see it well here. There's a small recovery on the AD lines. You can see it here where the NYSE picked up. And even more importantly, the bullish ETFs, the diamonds, the Qs, the spiders, the IWM, and transports all turned up with it. Notice here the TLT is remaining strong, falling rates, bad markets, good for bonds. Breadth remains weak and oversold despite a pop at the end of the week. These are stocks above the 200, stocks above the 40. These are still the lowest we've seen since 2010 on both, even after the bounce. 3-month new high, new low, a little bit faster acting, did bounce up considerably, but it's still low in the range and oversold. The daily McClellan, we picked a new low on the summation index. You can see how the oscillator bounced back to neutral with the recovery in the market, well, the 2-day recovery. And the weekly, similar, did not hit the new lows, but did drop further, and the oscillator back to the midline. Current buckets, we came off the lows. If you look back on the 24th, which is Christmas Eve after the market massacre, 99% of the stocks in the S&P 1500 were below the midline of their Bollinger Bands. 45% of them were below the Bollinger Bands. Another 35% were in the lowest decile, so that meant 80% of the stocks were at their bottom or below the bands. And we came off nicely and moved to the right. Still looking at this is a oversold market with 90% of stocks still below the midline of the Bollinger Band. You won't see a HINDY until you get new highs, so we should stop talking about them. The market tone, notice we fired off a series of Kahunas across the board, except in the Russell on the 26th, and each of the indexes switched to green here on the Woody indicator, which meant it was time to start looking at longs. Sector strength also improved, except as you might expect, utilities and real estate were laggards because they're the ones that were doing the best, perhaps, in the tougher market conditions. Canaries in the coal mine, yes, price lines now called bookings, but it's reflected in the chart. We're in a downtrending channel of the Canaries, and we are in the midline with the Doji, so you can't have any more indecision than that. To me, a lot of the stocks in that list, as well as throughout the market, are not at perfect shorting positions, but and my hope is that in the next few days they actually move into them. Know your news and earnings. So what happens on Monday is probably a little bit of tax loss selling in the morning. I still got some to do. And maybe we'll rally into the afternoon. I think it's a normal hours market. Obviously closed Tuesday. On Thursday, we've got some jobless claims and ISM. But Friday, this is a hold on to your seats day. We have the employment situation at 8:30. We have PMI at 9:45. And then at 10:15, we have Fed Chair, Fed Head, Deadhead, Jerome Powell. We'll see if he can talk down a little bit the fear in the market. I, for one, don't think this is about interest rates. I think it's about the quantitative tightening and the fact that that will drive rates higher. And take cash out of the marketplace. And I think perhaps he can take away the word autopilot and say that quantitative tightening may be dependent as well on economic data. That, in my opinion, is what spooked the market, but I'm a doctor, not an economist. There are some earnings per share, earnings reports this week, nothing major unless you own them. So first thoughts, huge relief rally on Wednesday and Thursday on oversold conditions. Markets limped home on Friday. Tax law selling has likely been a huge factor as the tax law changes start Tuesday. May see more selling on Monday, at least early. News likely to drive markets one way or the other. There were some leaks from China over the weekend that showed promise, but frankly, at this point, I think they're all Trump Twitter lies. Fed shutdown, it's over a half a day's budget. $5 billion is a huge amount of money to any of us. It's what the government spends between 8 a.m. and noon on a typical day. So are they doing this because of the dollars? Are they doing it over the idea of the wall? Maybe we'll see a compromise, maybe not. And then Powell speaks on Friday. Does he use it as an opportunity to calm the bulls? The economy matters. Do we see a recession, or is this just the impact of tax law selling in major ETFs instead of tightening and tough comps on EPS growth? Think about it. The markets are forward-looking, so a soft market has spooked people about a recession. And this time last year, we had some corporate tax breaks, and a lot of it were pumping up the balance sheet and also improving their earnings. So it's tough to predict, I think, this market in advance. I'm going to show you my three-road scenario, which I learned from Ian. Obviously, not this week's report, but the concept. And it might be rather late on the next. I'd rather be late on the next move than wrong. So last week, I'm sure no one watched to the end of the video, I put out my plan of the week, and I basically defined a box, and I predicted the market was going to come down to about 2380, and as you can see, it dropped further than that. I then put fibs on it, had previously put on the 200 and the 50 where they might be, and I noticed how convenient that the 38% and the 50% retracement and the 76% retracement kind of fell at very clear-cut, obvious reversal zones, the 50, the 200, or the top of that box. I'm going to adjust that, and we were pretty damn close. And let's talk about where we might go from here. So let's redraw the setup, and I actually took the box to the top of the range here and extended the 250, that's guesstimating. And then I put a Fibonacci plot on that. Scenario number one, we just go straight up from here to new highs. I think this is highly unlikely, not impossible. And boy, would that be the ultimate of all V bottoms. I don't think that's what's going to occur. I'm certainly not going to play from here. These circles are sort of areas of interaction between anticipated resistance and the fibs. Scenario number two, we just dropped down from here. So we ran up to the 23.6% fib retracement, and we just break down on Monday and we see new lows. Doesn't seem so far-fetched to me. Probably is a 30 to 40% likelihood in my mind scenario. This is where I think is going to happen. I think we're going to rally. Now, we may have already had the rally, or we rally up to the 50, which is about the 38%, or the 200, which is close to the 61.8% retracement, and we fall from there. This, to me, is the most likely of what we're going to see. We will have much better shorting points if we run up to the 50 and the 200. If I'm right and this happens, I don't want to be trapped up here. So I'm going to probably be using these gains perhaps for some short-term trades, but looking at opportunities for shorting. And I'm going to be careful because I don't want to be trapped by either a bull or, frankly, a bear trap. So let's put this together. Here's the cue just to give you a quick show. Last week, I was surprised that financials had popped up. And look what happened this week. They were the best group. You could see in brown that 7 out of 4 groups were up on the week. The laggards were, as I said before, utilities, real estate, also staples and communication services. The big winner for the week was financials. On Friday, the big winner looks like it was financials again. Other winners were consumer discretionary, communication, real estate, information services, and healthcare. If I look at the top 10 sectors over one day, financials and healthcare discretionary come to the top. If I want to look at healthcare because it had been weak, you see this is rankings, the higher number the better. It's moved up nicely over the last 10 days. Big pharma, healthcare equipment, healthcare supplies. If I clicked on the healthcare equipment, I brought up some of the companies, and I can start to do some analysis and drop them into HGSI and see if any of these look interesting. My game plan, be nimble. 2 of my 3 scenarios suggest higher prices ahead, at least in the short run. Do not get trapped. I'm trading small and I'm trading fast. It is not a time for buy and forget. I'm building my cash reserves so I can deploy when this market commits. And I just might as well give you the punchline. On my bottoms up review, there were few stocks and quality setups for either long or shorts. Typical top-down agenda to follow, but don't expect me to show you a lot of things to buy. And we're planning on around Halloween doing a Florida meeting in the coming year. So very quickly, let's look in my TradeStation charts and see if we have any clues there of change in the market from the last couple of weeks, or maybe we're not going to look at my TradeStation charts. Okay. This is what happens when you have a lot of windows open. There we go. All right. So let's look at E-minis. All right, are you going to... Well, maybe it's not going to cooperate today. Let's just try the other blue. All right, welcome to the land of TradeStation. It doesn't always function. Boy, do I wish they'd make this a 64-bit program. All right, I clearly got too many things open, so let's just skip this. I don't think there's anything profound that was going to come. Let's just look at HGSI. So I'm going to open up my designer. I'm going to go to Market Analysis and User Groups, Major Markets Plus. I'm going to hit my warehouse view, and they're going to pop up to the right of me. Should be 24 things there. I'm going to go to the top-down view, which is price and volume, and see where the strength in the market was on Friday. Spoiler alert, when the S&P and NASDAQ 100 and the 1500 and the S&P 100 are in the middle of the range, it's not a great day in the market. It's not a bad day. When silver, gold, and bonds are up top and small stocks, it's not a rip-roaring bull market. Small stocks up top are great. Gold and silver up top, not necessarily so. Let's take a look at some of the major indexes. Let's go into a different view. We've spent time on the S&P 500 already. A beautiful bounce. The question is, when does it stop? It had a eureka in the market after we talked about these phoenixes being irrational exuberance to the downside. We had a Kahuna. We had a green candle low. Certainly looks promising. The issue is, how far does it go before it reverses? If we look at the Dow Jones Industrial Average, looks the same, not going to spend any more time. I look at the NASDAQ Composite, looks the same. And if I look at the Russell 2000, which has been the weakest of the bunch, it looks the same, it's just lower in the pattern. If we go out and look at the dollar, which has not been a bad place to be keeping your money of late, the dollar turned down a little bit, as you'll see here. And this is probably good for small stocks. It's probably good for gold and silver. That may have something to do with what we saw on the rankings. If I look at the VIX, it's come down considerably. But remember when the VIX was at this level down here, or even at the 10 level for a long time? So it just broke down below 30. It's still pretty elevated, demonstrating the volatility and the risk in the current market. The gold spiders, weak dollar, are breaking out to not to recent highs, not new highs by any means. And the silver spiders, or iShares, about to run into resistance, have also been strong. Gold miners have actually been weaker than the metals, consolidating here at the 200. All right, now what has been strong, and I made a comment about bonds. Here's a TLT. And you could see, I think, how the bonds look a lot like gold and have broken above their downtrending 200-day moving averages. Now, one thing that happened this week is there was a big reversal in the market, and all of a sudden, if I look down on the F2 view, I see 90 industry groups have moved to the upside over the last 2 days, well, 2-day force, and only 4 groups to the downside, or 5 groups to the downside. It was 4, now it popped to 5. So that's bullish. Here's the problem. Let's take a look. Semiconductor devices. I looked at these with my son the other day as he's taking a keener interest in trying to not lose money and get better in the market, which is exciting. Here's NVIDIA. Clearly was a big leader on the way up. It broke down in October. This was the top stock in the top industry. Yeah, it's had a big move up, and it's a big mover, so it's probably got plenty of volume. Average volume is 17 million. Do you want to be buying it down here? I didn't think so. How about AMD? Well, it's perhaps setting up to be a base, but it's got a lot of overhead supply and big moving averages. I'm not ready to buy it down here. Intel, better, still well below the 200. As they say on Shark Tank, it's dead to me. And Broadcom, probably one of the best of the group. It's above its moving averages. We're about to see the 50 cross back above the 200. It's right below the PSAR dot. It had Kahuna increasing volume, mobile breakout from a squeeze. Everything's green up top. This one's on my buy watch list, but boy, that's not a trending clean chart. That's a messy chart. Qualcomm, no. Micron, really? Really? In this downtrend, does anybody really want to buy Micron? I don't. Maybe it's a good time to buy then. Texas Instrument, ditto. And then I get to the index group. So I look at these. Specifically, let's go right up to the top one, NVIDIA. And I ask, does anybody really think it's going to have come off this bottom and run all the way up to new highs? Or is NVIDIA like the indexes setting itself up for a pop and drop? When I say I'm looking for new shorting opportunities, what I mean is this is a very typical chart that we're seeing in the market right now, and I can't short it down here. It might be the buying opportunity of a lifetime, but not for me. I want it to run up to here and fail. And for me, there's a lot of stocks that need to have a run over the next couple of days before they're ready to short. So I'm just not a believer yet in this market. And I'm a guy that some people used to think was a perma bull. Somehow, banks have made it to number 2. Interesting, except I showed you last week and this week on the Q tools that they were moving up. First Republic Bank, big gap up. And a shooting star. Long or short this stock? Probably not long. It didn't run all the way up. Maybe I'm not short after that big gap up. But huge volume. I'd look at the news. Maybe. I'm not ready for that one. SunTrust Bank. Nope. And I'm right back to the index. Now, this was an interesting one. There were a couple of South American banks that looked interesting. 2.8% dividend. Basing here, if there's strength in financials and strength in foreign markets, break the PSAR dot, that might be interesting. Nope. 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 I don't see a whole lot to like on the banks. The same story as NVIDIA. Do they run up and become shorting candidates? Third one down, biotech. Boy, has this group been hammered. You got 2 above the index. I usually only buy the stocks that are outperforming the index. Look at Amgen. You know, it's above the 200, sort of has a shooting star looking thing here. I'm not going to touch this thing now, but if it broke above the 50 and held, I might pay attention. Right now, no. Aniline, no. Sarepta, no. Exelixis, another one that I have interest in, but it's got to get above these moving averages, and frankly, I'd rather buy it at $22.50 than at $20, because at least then I know it's breaking out to new highs or recent highs. Regeneron, you know, here's what it's moved up, but am I better off buying it or shorting it here? Depends what the market does. So one way to play biotech, and the way I pretty much play it because I work with a lot of these companies, is I look at ETFs. Here's the ETF of up, and this shows you, do you really want to be buying this? My answer was, by the way, was yes. I did buy some because I just thought biotech has been hammered and maybe we'll get a bounce. We've gotten a little bounce, but I'm not sure I'm going to be married to this position. And I think LABD, the short position of biotech, just gave you more of a hammer position after pulling back. That might be even more attractive. So I'm not sure biotech's a great story right here. Are you guys getting the hint here? Telecom, AT&T, do you really want to own it at $28.46? Well, a 7% dividend is attractive, but not if the stock goes down $2, then you're down 10%. You're down in the hole. I like buying these when they're cheap in an uptrend. I'm not sure I want to buy them when they're cheap in a downtrend. 7% dividend, no, because you're going to have resistance at each of these moving averages and probably be attractive short. Verizon, at least it's in an uptrend and a pullback, a dividend of 4.3. This one is more compelling to me. I guess falling rates are good for these infrastructure plays. No. T-Mobile, no. And then I get to the index. So I bet you're impressed with the number of new buys I'm finding on this trip down. There was one here. Sienna looked interesting. Let's take a look at a couple of these. Now we're going into the communication sector. Apple, I love their toys. Hell, my main computer for trading is a MacBook Pro that I run Windows on, but I don't really like their stock down here. At some point, it is a huge value play, and it's a great story. I just don't know that that's tomorrow. Cisco, no. Nokia, I don't want to own Nokia. It's a cheap stock, big dividend, but it's a sideways play. It's hard for me to see that this is a growth stock in a trend. Arista used to, we'll talk about growth stocks and trends. They go up like rockets, and they just come right back down. This was a darling of industry and darling of the market. Not now. Here's the only one of the group that I thought was attractive to buy now, and it's medium loose, but we clearly lower left, upper right. We're sitting above the moving averages. They're in a good formation. Here's the 200. The earnings aren't out until March 5th. Great earnings per share growth. 10 times what the PE is. Sienna made it into my buy list. Not perfect, but the best of the bunch. Infrastructure software. Here's another one that my son and I like. We like this one in Palo Alto, so let's look at a bunch of these down to the index. ServiceNow, again, it's rolled over. Seems to have stalled on the 200. A move up from here might be interesting. It's got good earnings, at least for the next quarter. VMware, not bad looking chart, above the moving averages. MindBody's a takeout. Microsoft, not yet. And Palo Alto's clearly in a not yet, but this has been a big mover in the past. You can see on the left-hand side. I think it's getting constructive here. It got above the 50. It's got great earnings coming in. I put this on my buy watch list, but I'm not sure if I'm willing to pull the trigger in this current market environment that we're in. Splunk, no. OQTA, don't know much about that stock. Fortinet, again, if I'm just going to limit what I buy to stocks and uptrends with pullbacks to support, it's sitting right on the 200. It's got earnings per share growth, but a high PE. Yeah, that's a possibility too. I got scared off a little bit by the PE. Exploration and production, oil's been hammered. You'd expect to see bounces throughout this list. I have no idea why the MDY is there, so we'll go through that quickly. Pioneer Natural Resources, looks like a semiconductor stock bouncing off the bottom. At some point, it's a good value buy. Whiting Petroleum, skip the MDY, although it looks like the MDY. Prudential Trust, ConocoPhillips, Encana, Canadian Natural Resources. They all look the same, deep pullbacks with a bounce. You're not buying them because they're great growth stocks. You'd be buying them because of value and a dividend play. Diversified banks, I got to like this since I still have a lot of Bank of America, although it's protected. Is it time to go back into Bank of America? At some point, Bank of America is going to be above its 200-day moving average. At some point, Bank of America is going to be a rah-rah stock again, just like JP Morgan and Citibank. I just don't know when. And right now, it's in a downtrend, hence why it's under protection. JP Morgan, downtrend. Citigroup, downtrend. Wells Fargo, downtrend. This is another one of those foreign bank holdings. Looks a lot better, 6.5% dividend into the group. So I'm sure you can see the hundreds of buy stocks that we're seeing this week. Application software. Is this a good time to buy Salesforce? It's still a damn expensive stock, excuse my French. But I know the company, I know the tools. It's a great story. It's got earnings per share growth. It's got revenue growth. Someday maybe it's a takeout candidate. I'm not saying it's a great chart. It's sitting at the 200-day moving average. It's probably a lower risk buy than some of the others we saw, but it's not I'd rather buy it breaking out to new highs maybe But if we could tighten up down here and break out, I think Salesforce goes on a buy list. Workaday is already broken out some. Adobe, yeah, I'm more inclined to wait for it to run up here and short it than to buy it here. Intuit, same thing. Forget Electronic Arts and Activision. Twilio is another one that I like a lot. The fundamentals don't look great, but consider the market we've been in, and it's right below its all-time highs, and it's still in an uptrend, and it's relatively tight, middle tightness. Twilio made it to my buy list. In Group 10, Electrical Power, can you imagine GE? Not me. No. 4.9% dividend. Now, if that dividend was maintained, that's a different story. But I'm not sure that's going to happen. Watt, they had announced their first sale, and then people realized it was a little sale, and it came right back down. And ABB. All right, so I think I've shown you to the long side. It doesn't look so great. I did come up with a buy list of stocks I was interested in, and it's probably worth sharing it with you and reminding you I'm not going out to buy all these. These are on a watch list. And let's see if this cooperates now. So that means I've got them on a list here, and I'll be monitoring how they perform, looking for new signals during market hours. I'm a little bit perplexed why this isn't working, because right now it does seem to be playing around. Okay, let me just... Nope. Yeah, it's always a factor of me having too many windows open, more so than it is of the program. Just try this. And it's only going to change one. I'm just going to look at the E-minis here, so let me just do this real quick. On the weekly, the E-minis are broken. Excuse me, on a monthly. On a weekly, they're broken. So is this a counter trend rally in a new downtrend, or is this the beginning of something new? Only time can tell. Odds are it's a counter trend and a downtrend, but we'll wait and see what the market shows. But I use Radar Screen, and then in Thinkorswim I use Market Watch. I use Market Watch as my tool during the day to look for changes. So these are the stocks that made it to my buy watch list, more than you'd expect, but none of them am I going to go out and buy right away. So if we look at where they came from, you notice the first bunch do not have an industry group. That's because they're all bond funds. Do I recommend these? No, but this is where the strength is, 1.7% dividend on short-term bonds. Here's 7 to 10 year. Here is intermediate term. Here is more intermediate term. Here is short term. All right. Would you say that all those look better, except for this one, than most of the stocks out there? I would. I put this one here because it's got a new uptrend. It had multiple pocket pivots and kahunas. Mobo breakout from a squeeze. So bonds look strong. I don't remember the last time I spoke about bonds on this program. Gold and silver. Here is Sprott, a gold and silver trust, CEF. They actually hold the asset. It's not, it's a ETF, but they hold the asset. Here's an MLP, big dividend, 7.8%. Here's another bond fund, breaking out for a little consolidation. Here's a South American airline. This one and Dizal look good. Here's Spirit Airlines, uptrend pullback to the 50. I mean, Are these perfect? No, but they're better than most of the things that I showed you before. Good earnings per share growth, much bigger than the PE. 5 and 9, here's a technology play. I'd like to see some momentum come in, sort of going sideways right now. Paycom, maybe this is here for old time's sake. I made a lot of money on this stock. Like some of the others I showed you, if you go to a weekly chart, this has been a big mover. It's now pulled back to support, so maybe it's going to run again. That's why it's on a watch list. That's all this is a watch list. Salesforce we looked at, Twilio we're at. I'm not buying this stock. It's not great liquidity for it trades less than 1 million shares a day. It's an expensive stock. But again, think of how the market has been ripped around, and O'Reilly Automotive has gone sideways during this market destruction. First Bancorp pulled back to support. Here's one of those international banks. This is an Indian bank. Here's Sienna Corp, which we talked about. Finisar is another one of these. Technology communications pulled back to support. It's in an uptrend. It held the gap, Bible gap up. I like the earnings per share growth. Here's another foreign bank. And then CareCom, it's one of the few stocks that showed momentum last week, broke above the 200-day moving average, and it's up over the last 10 days while the market's been hammered. Palo Alto Networks I showed you. And then Team is another one. This is an Israeli IT company, has managed to maintain most of its annual gains despite the market sell-off. And then AbbVie, if you're going to play biotech, this is an interesting player in that it acts like a biotech from a pipeline perspective, but it pays a big pharma dividend of almost 4%. And then probably should not have this here because it pays less than 500,000 shares a day, but this one looked like it was breaking out. Fluidigm, healthcare, medical equipment, going back to those Q slides. Vericel Corp, another life sciences company, pulled back to the 50 and breaking out. Hut Hut, Chinese hotels. Why did this one make the list? Basing, it looked good in TradeStation. Keysight, sort of got a triangle forming. We'll break one way or the other. And then I guess this is probably the last, near the end. This is my stock pick of the year from April 8th or so. I gave this to you at 6. It ran to 52. I think it's running again. It had a PSAR breakout. Kahuna's mobile breakout from a squeeze. This is Tandem. Still own a lot of it. I took off half to buy one of my boats. I will end up this year probably up across my Schwab and TD Ameritrade and TradeStation accounts, up over 30%. If I take out Amazon and Tandem, I probably would have been negative. And even Amazon's given up some of its gains. This has been my big winner, 6 to 52. Wow. And I bought this one after presenting it at a Southern California meeting. Still like it. I think it's going to run again. Evertech, payment processing, not huge volume. Again, think about the market we're in. This is an outperformer, high relative strength compared to the market. Kosan is a cheap refiner, broke out above the 200. Squeeze, teeny weeny dividend. Omega Healthcare Investors, a REIT, big dividend. You know, I always talk about when nice to buy these when they're cheap. Well, it's cheap. If REITs show any strength, you're buying it off the 50 on a big dividend payer. And then Mellanox is another foreign company pulling back to the 50. That looks good as well. And then Xperi is a semiconductor play, used to be called Tessera, gapped up based around the 200 and looks like it's breaking out again. Great earnings per share growth. So I did find some buys, But there are and here's Foot Locker sideways. Nike did well. They sell Nike, I believe, and that's why I'm going to be tracking this one. Earnings are not until March. So there are some stocks out there, and then Lululemon. If you liked it at 160, you should like it even more at 125. This is either a great position to short it, but if it breaks out above the 50, I might be willing to buy it and go long. Frankly, this is kind of indicative of a lot of my short thoughts, is that I've got great stocks that had big moves down. Now they're having moves back up right into resistance, and they're going to go down again. So I'm not convinced that Lulu's going to go up, but this has been a big winner in this bull market. So I wouldn't put it on my short list just yet. But that's kind of what I'm thinking about. And when I talk about that, let's go look at some of the stocks I thought might be potential shorts this week. And I say the word potential as well. Mellanox may got put on the wrong list. Allegiant Travel, and let's put them on the weekly chart too. One of the beautiful things about HGSI is what I'm going to show you right now. Let's open up another charting window. Let's put the weekly. So this is a weekly chart. And you got the 20-day moving average in blue, the 40-day moving average in red. You've got weekly bongos and kahunas. And you've got in red, we're tracking the relative strength of the security on the weekly versus the S&P 500, and in blue is the moving average. Now, I've found opportune buy points to be right here when the stock price breaks above the moving average and the relative strength breaks above its moving average as well. Now, just to review this chart, it's got a 21, 10, and 40-week moving average, price, and then the relative strength. So, Allegiant is weak. Look at the earnings per share growth. It's clearly in a downtrend. Do I short it here? You could, but what I'm really looking for in Allegiant is I'm looking for a couple days run up and then short it from higher levels. And you notice that the price versus SP, the relative strength, dropped below its moving average here. This is where you want to short it. Not down here, but I think if the market rallies, we'll get a better opportunity. Ferrari NV, same story, clear downtrend. I'd like to see it rally up to that 50. And then pound its butt down from there. Mellanox, yeah, this shouldn't be on the list. This looks strong. That's why I was on the earlier list. About Netflix, and why am I not talking about its seasonality yet? Because it's in a mother of a downtrend. Now, what do I want to see it do? I'd like to see it track up here, sucker all those people in, and then short it here. Bull trap, and I think that's possible. Or maybe I'm wrong and it goes up to 400 again on earnings. Right now, I'm going to take the safe play and say it has a little bit of room in it, and then it rolls over. So this is setting up a watch list for later in the week of stocks that I think are going to lend themselves to potential shorts. Same thing with OLED. Does it run up into the moving averages and roll over? WellCare Group, big downtrend, let it roll up here and then come right back down. But that's what I'm expecting on my shorts. Wix.com, it's already in a downtrend, but it's moving up. I'm not going to short it until it fails. And right now, the market is likely to go up a little bit before it rolls over. So I hope you found this useful. I'm not telling you to short any of these stocks. I'm telling you to go out and build a watch list of potential shorts. It is a challenging market right now. I do expect to see perhaps a small rally, but I really think that we're going to drop to lower lows, and that's why my 3 scenarios, I like the third scenario. But the reason why I got 3 scenarios, let me go back to them real quick before I say goodbye. It's very simple. What do I know? I'm just like anybody else. All I could do is guess, but I want to protect my capital. And I think the most likely scenario here is that we rally, whether we're done rallying at the 23 or we go up to the next obvious reversal points, and I think we come back and test the lows. Now, a successful retest of this low may lead to higher highs. So right now we're in an area that's going to be choppy. And so in my comments that followed, and I'll just reiterate them, be nimble, don't get trapped, trade small, trade fast, don't buy and forget, and build your cash. I'd rather be late than wrong. Have a great week, everybody. Happy New Year's.